Gold has been the third best performing assets of 2020, silver being the best performing asset of 2020 thus far. And I'm talking January until end of August, the quarterly performances, with the NASDAQ 100 being the second best performing asset class of 2020. Although many people think that the NASDAQ has gone absolutely mad, it's actually silver that has had a great year. So what happens when silver has a great year like this? Why is silver having a tremendous performance in 2020? Why is gold having a tremendous performance? And what does it all have to do with the dollar and the elections? I want to screen share and show you a few things that I think will be valuable to you as we recalibrate and look at decisions that we've made thus far and perhaps what we need to do going forward. So let's look at this. With the mining sector right now and with gold and silver, there are a few scenarios where gold and silver can actually correct pretty badly in the next 2-3 months here. So let's look at this. In March and in April, if you were brave enough to get in while you were seeing, people dropping dead in the streets of China and what we've seen in Italy that really created that circuit breaker week, it offered tremendous opportunity. One of the lessons to think about for the next time that a major event happens in the market is when you see a minus 35% drop in 16 days, you need to really think, are you a contrarian or are you a victim of this? Because if you were brave enough to buy or just consider buying, we published wealthresearchgroup.com/list right at the madness of this takedown, but all the companies that were featured in it, man, they're up 30, 40, 50, 70%. So that's one thing I'd like to point out. Silver bottomed right around that time, March 23rd at $11.99 an ounce on the COMEX. Ever since, it's almost gone to 30 on the 5th of August when it peaked. So this is a time to look at what has happened since August. We've almost had 2.5 months since then. And one of the big lessons is after such a big move over the summer, where July was the best performing month for silver since 1980, and within July, there was the best performing week ever for silver, you need to think about the fact that maybe right now, there's going to be weakness for a while because you need to spook out all the traders. And perhaps going all the way to 23 is not enough. Perhaps it needs to fall down further in order to really shake out all the traders and leave the long-term holders who want to see silver and gold go much higher and believe that their fair price is much higher. So what does that mean to you as an investor? Well, one thing is splitting purchases into increments in order to sustain blows better. But what I mean by that, let's say you've researched a company and you like it. The day that you happen to buy it doesn't have to be the bottom at all. And so it's much better to buy in increments. Let's say you create a scenario. Well, we'll do a scenario later on. A second thing is taking time to build positions. So understanding that, hey, this is not a do or die opportunity today. This is not a once in a lifetime opportunity today. Don't get yourself in the mindset that if I don't buy it today, this thing will leave and head to the stratosphere. That's not the way investing works, and that's not the way professional investors work. Plenty of opportunities out there. Let them come to you instead of getting into that scarcity mindset of I have to have this thing right now on my portfolio and I have to go all in and really big. A third thing is remembering the trends. You might be counterintuitive to the trend, or you might be too early. So as you know, being early to the trade is much better than being late to it. But being too early has a price to pay. And so think about that before you make big investment decisions. And obviously, you need to learn how to tolerate risk and volatility, especially with companies that don't produce any cash flow, or that their cash flow is very susceptible to prices of the underlying commodity. So what have investors been thinking about, and why do I think that we could see a big downside here in the short term for gold and silver? Well, for one thing, Wall Street is really convinced that the pollsters are not wrong this time. So they think that gold and silver could be under duress because a Biden win will actually put Washington in a standstill. So look at the following chart, and you can see that the amount of leveraged bets that interest rates are going higher is huge, and it's the biggest since 2006 by a long while. And the reason is that they believe that in the next few months it'll be very hard to pass any big stimulus checks when Trump is still in office, but Biden is set for an inauguration. So that will put a gridlock even more so than it is now. So a wait and see approach where the dollar is being held in a lot of portfolios at elevated levels, high cash levels, and no stimulus checks. And the thinking that the worst is behind us, so interest rates must go up to help with the recovery, is what's driving this force of speculative bets against interest rates. So what is the script? The script is, let me back up here. The script is a Biden victory is going to make it extremely difficult for Washington to achieve anything between now and the January inauguration. So no stimulus bills coming, or if there is a stimulus bill, it's going to be very small. Therefore, we have no way of knowing how things will develop. In the meantime, the investment community wants to have a large cash position. And therefore, there's a big bet against interest rates staying low. Now I've been investing since June of 2000 when I was 16 years old. My banker started asking me questions about where the income is coming from. I told him that it's coming from babysitting and tutoring basketball in the neighborhood and whatnot, and I was saving it. And he kept telling me, look, there was a dot-com crash. Stocks are very cheap. Why don't you start investing? And he actually convinced both of my parents to come into the branch and sign a waiver so I can start buying. And funny enough, he was the one that showed me the opportunity with China in 2000. So that was a lucky break for me. But I've never, in the last 20 years, I've never made decisions that pertain to who is in the White House. It doesn't matter too much. If you're mostly in long-term investments, companies can endure any president, any interest rates. Companies that are really good can endure any interest rate, any environment, because they're competing with other companies. And if they're a great company, they can just outperform other companies that are out there. And that has always been my approach. But that isn't the case with commodities, especially not gold and silver, which are very political commodities, and they trade with inflation and with the dollar. So what should we look at? Here's a theoretical example, and follow me on this one. If you have a $50,000 theoretical portfolio size, you take about 15% of that, $7,500, and that would be your allocation into speculative bets. The rest of it, the rest of the 42.5 should be in very reliable long-term opportunities. And there's going to be other videos on that. But remember, the first thing that you need to figure out is how much are you willing to speculate with? And you have to come to a number that is not too high. And if you want to speculate, that is not too little. Too little means, you're not going to make any important returns or life-changing returns. And if it's too much, you're really setting yourself up for a massive upset or a failure. So for me, it's always been 15%, and this scenario is 7,500. Then you split it, a proper diversification, into 10 companies, each making up $750 or 1.5% of the total portfolio. So when you have that kind of a scenario, if you do that right, even if companies that you buy end up failing because of management, failing because of timing, or just having a situation where the entire trend is going against you, the loss of that will not change the way you think. It will not leave residue or negative trauma in your mind. And it will not force you to say, oh my God, I have to recoup this huge loss and then you end up taking up more risks in the future. No, be a professional and split it into 750 times 10, for example, in this scenario. So 1.5% of your portfolio in each of these. This is a theoretical example. Now, how do you position size rightly? Well, you do it in 3 increments where you buy it on the day you like it, 33%. So that's $250. An additional $250 or additional 33% of the whole position. This is just in one company. If the stock falls 10%, 15%, 20%, look at its chart. Look at the way that it's trending. Look at its volatility. Some stocks don't fall 20% just on a whim. Some do. So look at that. And the last 33% or $250, if it really falls another 20%. Then you set a stop loss to your average cost basis of 36%. Why 36%? It's been proven that that is the ideal stop loss statistically speaking. So a breakdown. Let's say company A trades for $1. The initial outlay is made $250 at $1. The stock then falls to 80 cents or 20%. So secondary outlay is made $250 at 80 cents. Then commodity prices continue dragging the mining stocks down, for example, another 20%. So now you're looking at 64 cents and you purchase your last outlay. So you've now purchased $750 worth of stock in one company, which is 1.5% of your whole 50K portfolio. So you're being very professional and conservative. And your average cost basis, because you bought it 3 times, one at $1, one at 80 cents, and one at 64 cents, is actually 81.3 cents. So your stop loss, if you want to risk only 36%, which is the ideal statistical stop loss, is 52 cents. So what can happen here in this scenario? The risk reward. If the company does what it's set out to do, you're potentially looking at 500% return. So in my opinion, do not go into speculative bets unless you're able to make at least 5 times your money. There's just no reason to do that because there's so many other companies in this speculative sphere, so to speak, that can return that much. So why go for less? If the company fails or everything goes bearish, you're potentially losing 36%. So in numbers, how does it look? $1,000 can turn into $5,000, which would make this a winner for you. Or $1,000 can turn into $640, which will make this a loser for you. So the equation is, are you willing to risk $360 to potentially make $4,000? The risk reward is 11 to 1, and that is pretty good. Now, we have to remember that in the speculative world, many don't turn out right. So the 11 to 1 is because when you take this portfolio and you multiply it by 10 in order to create that 7,500 portfolio, you need to figure that 6 or 7 of these will not work. So you're going to lose $360 times 6 or 7, and then you'll make $4,000 times 2 or 3. It ends up being a profitable trade, very profitable, but it only works if you do it spread out to 10. If you just take one company and say, let's wait and see. Let's see what happens with this. You're setting yourself up for a loss. You're betting against statistics. If you spread it out on 10, then you're really giving yourself a chance. And that's what a lot of speculators do. They say, I'll speculate with one company. Let's see what happens. They lose 36%. And then they speculate again with one company. They lose 36%, and then they're out. So they never built that portfolio. I hope that makes sense. Okay, so the number one biggest decision mistake, in my opinion, is buying the whole lot on day one, because there is nothing unique about the day you buy it. It's arbitrary. Okay, so you have to think in terms of weeks and months. Okay, let's go back to the Biden scenario here. A Biden victory. It doesn't change what Goldman Sachs is thinking about gold and silver. So they have a prediction where gold is going to at least 2,300 and silver is going to 30. That's a big move for both of these. And obviously very good for the mining companies as well. Now, let's finish today's video with this. There are long-term trends, one of them being a bull market for gold and silver right now, which started, you can look at December of 2015, where the nominal price bottom or what I like to look at is the Dow to gold ratio. That bottom in September of 2018. So we're either in a 5-year bull market already or a 2-year bull market already, depending on the way you look at it. In my opinion, the downside right now is $1,820 an ounce for gold and 23 for silver, 23, 22 for silver. Obviously, mining companies are going to get dragged down with that kind of a move. So a slap down by $100 for gold and or by $1 or $2 for silver could be huge. But in general, under a Trump or a Biden administration, nothing changes for interest rates, nothing changes for deficits. And with stocks being so expensive, it's very cheap to hedge with precious metals. That's why it's happening. Look at the big picture here. Commodities as a whole have never been cheaper compared to the broader markets. Never. Even at the dot-com bubble, which everyone thinks was the ultimate bottom for gold and for commodities, it wasn't as cheap as it is today. So bulls in your court. I hope you enjoyed this. Do you agree with this? Do you think this is totally wrong? Please comment and let us know. And obviously follow the newsletter, the wealthresearch.com newsletter, because this actual piece was published in the newsletter, and there are many more that get published every Sunday, Tuesday, and Thursday weekly. And we also cover specific opportunities as well. Thank you for watching this.